All right, good afternoon, everyone. Thanks for joining us today to talk a little bit about what's going on in our real estate markets here in Silicon Valley. Had a lot of good information for you. Hopefully, answer some questions that you, or maybe more importantly, your clients might have, buyers and sellers, about what is going on and perhaps what they can expect in the next few weeks and few months as we end 2020 and turn into the start of 2021. Since the last time we spoke, we still we had not had our presidential elections, and we did not have a vaccine. So two major things have occurred since we last spoke a little over a month ago. And we'll talk a little bit about both, but not too much. I think the markets have already priced both of those events in a long time ago, and the way our markets have reacted since June are kind of statement of that fact. It's more about who remains out there, how are the vaccines going to work, and how our economies, will they continue to open up or close down in the short term, near term, long term. And so we'll talk a little bit about all of that, and hopefully, again, really prepare you for what we promised several months ago would be a very, very intense winter in terms of real estate activity. We promised that, and it was delivered. And we're going to continue to see the same through the first part of 2021. But more than just saying, will the market be hot or cold, or up or down, I want to show you some of the exact places where that might be happening, why it might happen, to better prepare you and arm you to go out and conduct your business at a high level. So let's jump right in. And before we start, I don't want to make this presentation about coronavirus, neither do I want to ignore it. So I just took a screenshot of what I opened this morning, and it kind of gives you the lay of the land, so to speak. There's a lot of work going on in Congress right now about a COVID-19 relief bill, a second or third one, I believe, at this point. A lot of good news coming out of that, a lot of progress finally. And so that is an indication of where we think we are. We still need help, but more help is coming. You see grimly in the middle there, the graphic with the image with a coffin. And we're kind of in that midpoint where people are really being affected. Infection rates and deaths are rising and alarmingly high. At the very same time, the vaccinations are starting to go out. The news on how effective they are has been really, really positive. I think Moderna might become getting theirs approved in short order. We started seeing video of the first healthcare providers receiving their vaccines early Monday morning. And so we're kind of going to be in that period for the next several weeks where continued bad news as we deal with the latest growth, along with a lot of good news about what we see in the future. And remember, most people out there are thinking about their real estate decisions long term. And so keep that in mind, even as we are faced with more lockdowns potentially, and more illnesses and more unfortunate deaths. The long-term view is good news, and that should affect our real estate market in a positive way. So if you've ever run a marathon or a long race, I have, believe it or not, we're in that part where you're not quite there to the end, but you know it's coming, you know it's getting closer. Your legs are feeling like absolute rubber, and you don't know quite how you're going to make it to the end. But if you at that point choose to focus on the very next step and the next step and just keep really grinding, you'll finish. And I think that's where we are. Again, a lot of bad news hitting our browsers every morning like this, but it has a lot of really good positive news right behind it and concurrently. And so try to keep that in mind. I know it's difficult. I know we're all going through it. 9 months is a long time to do anything. And here we are with a few months left to go. But with that, I'll remind you, we talked a few weeks ago, I think it was to my office, not to the general audience, But I said, look for lockdowns. And I said it because of, not because of the number of deaths or number of illnesses, but because of hospitalization rates. And so I want you to show you a couple of things. If you must watch the news and want to look at this, look at these two graphs and these numbers. And these are things to watch in terms of what's going on generally around COVID, what's going on lockdowns, what's going on around timelines and things like that. So we can see that early on, early 2020, we saw a massive rise in positive cases. And in terms of relative to the number of people tested. And of course, that was because it was early, it was new. People didn't go get tested until they were in late stages or really showing symptoms. I'm sure there was a lot of asymptomatic people walking around back then, but they weren't getting tested. So we saw these high number of positive results, low testing numbers. As the number of tests per day increased, we saw that initial slip down. More people got tested, lockdowns came in place, positivity rates went down. Over time, it's trended pretty well. We get better and worse. Here we start to see we're at the peak levels of testing, and we're hovering right around a 10-12% positivity rate. We want to, listening to the experts, we want to be down in the 5 or 6% to really start to get a hold of this. But what that means relative to our business, lockdowns happened the first time because of the unknown. We saw people getting ill, we saw them testing positive, we didn't know what was going to happen, and so we locked down right away. Since then, we know a lot more, we've experienced it, and we start to focus, at least I am, in terms of lockdowns and we'll be able to conduct business, we'll be out and about shopping for homes and considering buying or selling properties. This is what we watch for. Positive tests and hospitalizations. As positive tests rise, hospitalizations do too. And when hospitalization rates get too high, that's when we lock down again. Again, before the latest lockdowns were issued, we talked about this. I said, watch this. If we get to a certain level, we will lock down. We hit the 15%. Today, the Bay Area counties hit 12.7% capacity remaining in ICU units. So the remaining Bay Area counties that had not yet moved into the bigger lockdowns are now with us today, I believe. If we get into the 10 or 5% availability, look to see if we lock down even further. But this is in terms of your business, in terms of what you can do, how the economy will be affected. These are the bigger numbers to watch short term. If these latest lockdowns reverse this trend or at least stop it from rising and we keep some capacity in our ICU units, we won't get locked down even further. Even with these latest changes, we've still been deemed essential in real estate business. Listings, offers, closings are still happening at a very high rate. So as long as we're within this band and as long as they don't increase lockdowns and shut down even more activities, everything I'm going to talk about you after this should be A-okay, no problems. If it changes, we'll adjust what we're saying and how we're saying it. But for now, keep this in mind. This is understanding going forward. We have a new president. We've gotten through the fall and into the winter in COVID. We have a vaccine now, or vaccines. We are still facing an uphill short-term struggle with hospitalizations, positive rates, and deaths, but a lot of positive things to look forward to. And we know now our industry can operate in this environment. So this is why I wanted to start with this. If something changes dramatically on this end, then some of the things we'll talk about might change, but I doubt it. So with that, let's jump in. What can you expect for the last couple of weeks of 2020? And then really importantly, what are you looking at for 2021 and how we should conduct our business? What are the questions our clients are going to be asking of us, and what are the best answers for them so they can make wise choices about their real estate futures? All right, so Keeping Current Matters, many of you are familiar with it, one of my favorite places to go for information. I will warn you, and I've always warned you, this is national view, this is big picture view. It doesn't always correlate exactly to what we are doing or we are experiencing in our Bay Area counties here in Silicon Valley and in neighborhoods within these areas. But this is a great place to start. They do a really great analysis of big picture, how we're ending the year, and how we should start the year. We'll start with this, and then I'll share with you more localized information. The beauty of this is the story is almost the same. Your clients are going to be much more receptive to a national publication like Keeping Current Matters and what they're saying is going on than they were if you just say, well, Robert told me or Robert said. They don't know who Robert is. I think I'm right, but it's very important that you always establish a really good baseline for your clients of where you're getting your information, what it's based on, and how and why they should trust it. So let's start with that big view where you can always point to, you can send them these reminders and these alerts in their emails or on your websites. And it's all positive, and it's all pointing directly, almost in the same direction. But they start with this, the housing market recovering, where we've been and where we are and where we're going. And it looks positive, looks great, right? Since May, just shooting straight up. And this is from Realtor.com. And what it shows in a very graphic sense is how our housing market has rebounded, and how it's gone way better than we could have expected. And in total, made 2020 in some ways a better real estate year than 2019, and that was a good year. But they break it down and they say this recovery relies on four things: demand, supply, price, and time on market. All these things working together tell you whether the market is going up, flat, or down. Now, each one of these, in our area especially, demand is high, supply is low, price therefore is high and rising, time on market is low and dropping. All of these things are important. Each one of these things is an important element. They alone and combined change the market, and they change direction when they have the ability to. But remember, each one is important, but the most important thing is how they interact. Meaning, just because demand is high doesn't mean prices will rise. If demand was rising at the same pace as supply, prices wouldn't rise. The inverse is true too. If there was no supply, that doesn't mean prices will rise if there is no demand. Conversely, if you have really low supply and really high demand, now those two things individually tend to create higher prices when they're happening at the exact same time. That shows you what we've been experiencing since June, July, August, and prices continuing to rise, because these things are not only individually affecting, creating a market where prices are rising, but how they're working in conjunction with each other is creating an even bigger impact. And that's what you've been experiencing. And so first step, looking forward, what's going to happen next year? Ask yourself these questions. If you're a buyer or seller, ask yourself these questions, or of your realtor. Do we expect demand to continue to rise? Yes, we do. Do we expect supply to remain low? Yes, we do. Higher than it is now, but historically low. So should we expect prices to rise? Yes, we should. And time on market, you need to act fast. If you see something you like, you should make a bid for it, be aggressive, and go for it, because it will be gone, because time on market is dropping. So I feel really comfortable about this for the first 3-4 months of the year. If you've been with me for a while now, we were saying this in June, because the data has just been pointing us in that direction. If the data change, if the inputs change, our opinion will change, but the data has not changed. It continues to remain on this path. So our opinion remains the same. Expect a really active first 3 or 4 months of the year. All right. So KCM points to ask this question: are prices going up too fast? Over the last 8 years in Silicon Valley, this question has been asked many, many times, and each time the answer has been no. What does that mean by no? The market shoots up in a given period, in a 3 or 4 or 5 month period, and then it catches up, meaning either because prices rise, more sellers rush to put their home on the market, thus taking out some of the demand that was driving those prices higher. But here's what we can say for sure about the last 12 years. While it ebbs and flows, it only goes up over time. It has only gone up over time in the last 8, 10 years since around late 2012. And you expect that to continue. We do watch for it. We do have to be careful of it. At some point, a price is too high. We're not there yet. We won't be there for a little while, but it's a truism. You know, at some point, you just won't go over a certain price for any product or service. Housing is no different. So the only place it's different is that you have to live somewhere, and the demographics show more households will be joining us and forming in the next several years, and we'll talk about that. So I think there's a lot of room still left for prices to go up as long as these conditions remain the same. And again, it's not bad news for a buyer. If I tell you as a buyer, you need to be aggressive, you need to go in and pay this, understand you're not buying at the top of the market. The market is still has room to go up. If you wait, you are getting closer and closer to buying at the top of the market. So if you have the ability and flexibility, want and desire to own real estate now, sooner rather than later is better. All right. So Craig Lazara, a managing director of the S&P Dow Jones, writes, housing prices were notably strong in September. The National Composite Index gained 7% relative to its level of a year ago. Our 3 monthly readings since June of this year have all shown accelerating growth in home prices. This is the kind of thing that's worrying some economists, like, is it going too fast? Going back to that question. And while all of this is true, I'll remind you that the front end of our typical selling season, where we have the usually outsized gains in March, April, May, were disrupted big time. So in my opinion, a lot of this is catching up more than a new late year trend. So what the gains we've seen since June, July, August into December, it's not a brand new phenomenon. It's not something that we can look for November, December, January's in the future. It's short term for now. All the conditions early in the year created this late year gain instead of the early to mid year gains we usually see. So remember that as you start to look at month over month and year over year numbers in the next 6 or 7 months. You'll have to take all those with a grain of salt. What does that mean? When we get to January and February, remember how hot that was last year? More so when we get to March and April. Our numbers are going to look through the roof, but that's because it was completely stopped last March and April. So start watching for these national numbers. They're not going to lie to you, but it's going to take a lot of in-depth information and knowledge and understanding to get past what does the big headline number mean and how is it really affecting us on the ground locally. So still good news. I'm not trying to diminish it, just trying to explain it and rationalize a little bit why we see such big numbers late in the year here. All right, so again, they show from home price appreciation. Again, been going up and up and up. We say that all the time. It makes us sound like salespeople, but it's grounded in fact, grounded in reality. So you can see here, since 1991, it's increased by 3.8. Since 2012 alone, it's increased by over 6%. Now think about that. That includes the period between 2007 and 2011 when it dropped. So over time, you've heard it a million times, you've said it a million times, if you're doing your job properly, real estate long-term is always a good bet. We can say that because we have this kind of data to prove it. All right, and now, what do we expect going forward? Again, if you just look at overall appreciation, continues to rise since 2000 all the way up. When you start looking a little closer, we have periods where it goes up higher than others, but notice they're all positive. And so right now, we're experiencing this big rush, this big late year 2020 rush and rise in appreciation. We may not see that all the way through May, June, but overall it will continue to rise. And I think it'll be front loaded in 2021. Most of our appreciation should come in the first 4 months. That doesn't mean the last 8 to 7, 8 months will be negative. It's just that we will see lower rates of appreciation to normalize the trend over the entire year. That can affect how and when you decide to buy or sell. If you are super strong as a buyer and you have cash and you're able to go in non-contingent offers, you can compete in the front end of the year and actually get a lower price. you are bringing in some risk with non-contingent offers and putting more of your cash up front if it doesn't appraise immediately. But big picture, you'll pay less in the front half of the year than you will in the second half of the year. If you don't have that much cash, if you don't want or can't risk a non-contingent offer, you will pay slightly more on the back end, but that home will still be there for you. It'll still be appreciating, and you can temper the price with lower risk by putting less of your money up front, by being able to write contingent offers, being able to go in with a loan or contingency or appraisal contingency and feel a little bit better about your long term. So being liquid, having the cash, having that flexibility, you're going to win on price. If you can't or you won't win on those factors, you'll pay a little bit more, but it might be a better decision for you personally. So you give or you get in these scenarios. It's not a right or wrong answer. It's more about where you are as a buyer or seller at that point, what you can or can't do, what you're willing or not willing to do. So start thinking about that now. If you have the need or want to buy a property in 2021, think of that if you're thinking of selling. If you want to make it fast, if you want to get a big rush of people, if you want to get quick deals done, first half of the year. If you're like, I can wait, it's okay if it takes 3 or 4 or 5 weeks in the back half of the year, I'm going to get an extra half or 1 or 1.5% on my value, that's also a good decision. So no bad decisions here, all about your wants, your needs. Talk to your realtors, make sure that you're in conjunction and thinking, and create a strategy based on these numbers. And if you keep tuning into this, if these things change, if you decide right now, I'm going to sell summer, late summer or early fall, keep up to date with what we're talking here. And if we see the numbers turning and we see we're not going to get the late year rush that we expect, you can always adjust your plans sooner. All right. So hope that makes some sense. And just a last one here. I think it's the last one. As we talked about earlier, inventory and home prices. You see home prices continue to rise as inventory continues to drop. This is going to be a really important issue going forward. As you look at national numbers, as you look at regional trends, as you look at data from normal suppliers like NAR, CAR, or any of the other services out there, remember, most of this is backward looking. It's looking at the last 2 or 3 months of information. And that doesn't mean it's wrong. It does show you the trend, and the trend will continue. But like I'll show you in a few slides, inventory is actually rising in some key spots. It has been for the last 3 or 4 months, right? So if you're a believer in this, if you're a believer in as inventory drops, home prices will rise, you've got to be really cognizant of areas, subsets of areas where inventory is rising year over year. Because if it is, then eventually this truism will hold there. And if inventory continues to rise in very specific locations, prices could be adversely affected. At a minimum, they can stop rising. It would take some extended period of inventories rising for prices to drop. But again, as a consumer, as a realtor advocate for those consumers, you're talking difference between tens of thousands of dollars if you don't understand the localized information vis-a-vis this, these national or regional trends that are backward facing information, not forward facing. I'll flesh that out a little bit more and make it a little more clear on what that means in our local markets in a few. But again, wanted to set the tone here, wanted to set this up for you. So Lawrence Yun, our favorite economist, finishes up, such a frenzied activity reminiscent of 2006 raises questions about a bubble and the potential for a painful crash. Long story short, we've been saying this over and over. No real comparison here. Very different fundamental factors going in there. Again, if you are a consumer and think prices are going to crash, meaning you're a homeowner and worried about your equity, or you're buying and saying, I'm going to wait until they crash and then get a real bargain, no go for either case. It's not just me saying it, we want to show it to you, right? So here's big picture, what I always love to share with the realtors that I train, want to understand this. This is what a price crash looks like. Inventory looks like this, almost 6,000 units, right? Sometimes it feels like we don't get 6,000 units in a year anymore. These are per quarter. So always talk to the professionals I train to look at this. These are buyers making decisions on homes available for sale. The pending numbers are relatively calm in all the other volatility in the market. The number of buyers remains pretty steady. That means the number of closings remain pretty steady. So if the number of buyers and the number of closings remain steady, and the only volatility is the number of properties for sale, obviously going back to the initial slides, the more properties for sale with the same level of demand, prices will drop. Now, understand how wide and long this is, and then look here where we are now. There's no real big gaps, no real dramatic rises in inventory. We do see them short term in some important places, and I'll share this with you here. Remember how 2018 started the year on fire, and I'll remind you, I'll have you look at the inventory for sale. 16 and 17 just dropped dramatically. That created the scenario for a big, like 4 or 5 month burst of growth in equity because inventory was so incredibly low. Then what happens? Those properties go on the market, they give 10, 15, 20 offers each, prices go up by 200,000, 300,000, and all the neighbors want to cash in, and inventory rises. And we get these, then we get that rise late 2018, all through 2019. Remember, late 2019, we started reading stories about median prices drop in Silicon Valley. This is what was going on. You don't need this massive number to create change in our markets. Even relatively muted changes in inventory and demand can create problems or issues. It does not create drops in prices. We did see median prices drop. That's a time. Well, we can discuss on a future date the difference between median prices and actual prices. But that's what you should pay attention to in the next 2-3 months as you continue to work with your clients in your business over these next couple of cycles. And reminder, COVID is right here. I'm not ignoring it. I'm not forgetting about it. But the housing market is so vast. It's so big. It has so many inputs and outputs. Even something as dramatic as lockdowns and COVID-19, big picture, don't change the fundamental track, right? So if you're in a bad spot and you're being negative right now in terms of the housing market, pull back and look at this and know that we shouldn't expect any dramatic changes in inventory. We shouldn't expect any dramatic change in buyer demand, which another way to say is the economy and interest rates. And so we should see a relatively calm market, big picture. However, what we want to focus on going forward, establishing the big picture calmness, is what about your neighborhood? What about your home? What about your price point? There will be some volatility. And that's going to be the real difference between what you as a consumer are making decisions on and realtors as an advocate and consultant, you're helping and guiding your clients with to make decisions on when to list, if to list, when to buy, where to buy, and things like that, okay? So just want to calm everybody down, want to make sure everybody understands this is not happening. Don't worry about massive price drops or bubbles. It's not going to go on. There's a lot more detailed explanation that Lawrence or any of the economists could give you. I just say, look at the numbers, look at the big picture. Nothing there is going to tell you prices will drop. It's the exact opposite, and that's what we're going to get to. All right, another really, really good. We talk a lot about affordability. We talk about, well, prices are so high, they're out of reach. Understand, as long as you can afford it, the price doesn't really fundamentally matter. It's an abstract number. If you have the means to pay it, it's affordable. And this is one way of looking at household debt service ratio for mortgages as a percentage of disposable personal income. That's a mouthful. What does that mean? It doesn't matter what it costs. I can afford it, right? So if values continue to rise in Silicon Valley and you're worried, well, it's got to be a bubble. It's got to be, it's inequitable. Well, look, historically, household debt service ratio, that just means you take what you bring in income and what you spend, including for housing, and it's at a super low rate today, right? We're nowhere near these numbers here, 5%, 6%, certainly nowhere near with the 2007, 7.21%. So we've got a lot of room there. What does this mean? That means if the prices continue to go up, which they will, buyers can still afford it. They can still service the debt. It will become an issue of not can I afford it, but like, am I willing to pay that much? That'll happen way before they can afford it. And you'll see that in the numbers. That's why we always talk about next 3 or 4 months, no issues, no worries. Next year or so, no real issues, no real worries, because these numbers are huge and they don't change overnight. They don't change quickly. They don't reverse trend. And you can see the trend here almost over a decade. It is over a decade. Amazing. It continues goes lower and lower and lower and lower. All the time since around 2012, prices went higher and higher and higher, but the ratio dropped, right? So that's what you want to look at. Can people afford this product or service with their current economic condition? Overwhelmingly, the answer is yes. And that answer will be yes moving forward for the foreseeable future. All right, so let's start looking a little bit further ahead. What does 2021 look like? Well, you know, if you've been paying attention for the last 15 minutes, it looks great for real estate. It looks great for people who can afford to buy homes. I say that on purpose. Those that can afford to buy a home. I'm not discounting that these prices are high, but they are out of reach for a lot of people. That is another webinar. That's another issue. That's another conversation. Today, we're talking about that subset of people who are interested in buying real estate and have the means to do so. And that subset of people that own real estate and are seeking to exchange it. They want to sell it, move out, move up, move down. Can they afford to do so? There's a lot of questions about that right now, but just understand that those two subsets right now, that group of seller that can sell and wants to sell, and that group of buyer that wants to buy and can buy, are really good, and the buyer subset is larger than the seller subset. So that's gonna. I don't mean to dumb it down so much, but in some ways it is that simple. Bigger group of buyers than there are of sellers right now and looking forward. So 2021 is going to be great. If you can't afford a house in Bay Area, 2021 is not going to be a good housing year for you. If you are house rich and cash poor and you would like to sell but can't, 2021 is not a good housing market for you. But those are factors that I can't change. I can't do anything about. You as a realtor can't do anything about. We can only work with those people that fit in one of those two subsets. It's up to Congress, our president, and our local and state governments and the economies to create more opportunities for more people. But again, that's a different webinar. That's a different conversation, an important one, but we're focusing on those two groups right now. All right, so mortgage rates, they're low and they're gonna stay low for a long, long time. I don't know if we'll ever see high interest rates again. So our economy would probably tank if we did. So that's kind of baked in the cake. Certainly for the first 3 or 4 months, nothing's gonna happen. 3% and below, right around that area. After June, July, vaccines take off, the markets roar back open, a full economy again. Maybe the Fed starts worrying about inflation, things like that, and maybe it ticks up a quarter point, half point. Those might happen, but are they going anywhere in January, February, March, April? No. They're going to be right around this rate, right around this number of 3%. That's what Freddie Mac, Fannie Mae, the Mortgage Bankers Association, they're all projecting that, and it's for good reason. It's for good cause. So look for that. This has been one of the principal reasons why our markets have taken off, and this specific portion of our business will remain low going forward. So 2021, almost everybody expects it for inventory to recover, maybe even grow a little bit. Number of transactions will be steady. Some predict a little bit less, some predict a little bit more, but all in all, I mean, this is really wearing rose-colored glasses, but 2020 was a good real estate year. And it sounds crazy. I'm almost embarrassed to say that, but it was. And so based on that absolute number, 2021 will be the same to slightly better. So look for a good year. That doesn't mean it's going to be even. It doesn't mean for everybody. It doesn't mean everywhere. And this is what we want to talk about now, right? That was bigger picture, national, regional. What about our county? What about where we live, where we work, where the majority of our clients are making real estate decisions? What are we looking at, right? So remind you, we experienced an extremely active fourth quarter in 2019. Seems like forever ago, but if you were paying attention, certainly if you were in my office, we were doing it real time because we look at this all the time. In October, November, I was telling our office at the time in 2019, be ready for a above normal November, December, and it hit. Why? We just tracked the numbers. We could see real time that inventory from around the third week of October had dropped by half. So again, that supply gone. We could see that pendings, while falling, had maintained and actually outpaced active listings in single family residences and was strong in townhomes. So we could see that in real time, and we knew that's going to create a hotter than normal November, December, and it proved too. We see the same thing this year. They didn't quite fall quite as far or as much relative to 2019. But what we did see is pendings grow even further. Now, I'm not talking about the absolute number. We have 913 pendings this Monday. We had 1,200 on October 19th. But compared to the active listings, remember, each factor is important on its own, but really important when you join them together. So inventory dropped, demand went up relative to that inventory, and it was outpacing it. So not quite what it was in 2017 when we had that white hot start to 2018. Some of you remember in June, I started saying, look at this. Look how we finished 2020. See if it's like 2017. See if we're going to get the explosive start to 2021. It didn't. It didn't maintain that pace. Inventory started to go up. Pendings did not almost double. But talking about last quarter of 2019, which started a really, really good first quarter of 2020, we see the same scenarios and even more so. So expect 2021 to be somewhat between the 2018 start and the 2019 start. That's a great start. That's a fast start. That's going to be a lot of properties on the market, a lot of buyers in that market driving prices up in a relatively short time. In 2018, it burned hot and fast, and by May, we were done. The market went into not a slide, it never declined, but it kind of went on this level path almost all the way through 2019. Started to recover as inventory dropped, and then 2020 started hot. We know what happened in March. We went through what we went through, and then we finished strong. So these are the numbers locally that allow me to look at what we see regionally or nationally and say, it's good here too. So taking that view down into Santa Clara County, I can tell you January, February, March will be really, really active. If you follow these numbers, follow these trends, you're going to be fine. You know where the sellers will be. You know where the buyers will be. You know buyers will be rewarded for being aggressive and buying early versus late in the scenario I talked about earlier, where prices will rise over the year. All right, so watch for this. Now, having said that, in a few minutes, we're going to talk about in your specific neighborhoods. I'm talking about not just the county. Some areas will be up and some areas will be down. Overall, the county's numbers will be great. But what about where your buyer is buying? What about where your seller is selling? You can't use a national number or a county number in that scenario. So we'll talk about that in a second. But here you see how we've moved in from third to through the end of the fourth quarter in these years, and it's very similar, very similar. And these kind of trends are what you can use as a consumer or as a professional to look into the future, see what's going to happen next. What's going to happen next? Well, you know what happened next now, in hindsight, when you see numbers like this. That means you have a very, very good idea of what will happen next because you understand these trends. You understand how these numbers and these trends interact and how they support growth, they support prices going up, and get your sellers and buyers ready. All right, so let me see. By myself, I think somebody raised their hand. I'll try to find out what that question was and get back to it. So again, Freddie Mac outlook for 2021. Some of you in our office have seen this. I'll go through it very quickly. Basically, mortgage rates going to be flat to lower. Total home sales, look for Q1, Q2 of 21, going back to historical norms. We had a great start in 2020 and it dropped off a cliff and then backloaded in 2020 in the third and fourth quarter. This year will be far steadier. It'll be more typical of a real estate year. This is a little bit elevated, but it'll maintain throughout the year. So we won't get these mad drops and these big rushes up. So look for steadier increases year over year in each quarter, with this initial rush focused on Q1, first month of Q2 for sure. You can see the differences between this year and last year. House price growth percentage should see a steady 2.6% in 2021. That is not the kind of sexy numbers we're used to in Silicon Valley. Again, this is national. So we'll show you. I think it'll certainly be higher here, but it will be positive throughout the whole year. Originations, you can see they're expecting a big number, 1.4 billion, I believe this is, higher than it was last year or this year. I'm already into 2021. So again, with a caveat of I understand COVID happened, but when we count all the numbers for 2020, really good real estate year, and next year will be bigger and better, right? So I'm going to go up a little bit faster. Buyer demand, still red hot. Mortgage applications continue to stay high year over year. Again, this is one of your big leading indicators going forward. If you always want to pay attention, what's next quarter look like? Look at, are people going to apply and applying for a mortgage to buy a home? That is always one of the first indicators of what you can expect going forward. We do not expect this to drop. Mind you, because it was such a hot year, the year over year numbers have been 25, 30, 40% this year. Once we get into January, they may not seem as sexy because January, February were hot of last year. So don't be concerned if we're not hitting 20, 30% year over year in January and February. It'll still be positive, it'll still be growth, and it'll still be built on top of a really powerful third and fourth quarter. So don't look for the amplitude, look for the direction, all right? Let's see. Helen, you have a question? Can you hear me? Okay, maybe she can, maybe we can talk to her later. Someone else is raising their hand. I'm worried that you're not hearing me or something, but I can't see who is raising their hand. All right, so I'll have to take it on faith and keep going. All right, so again, this is from what we're looking for next year. People taking out mortgages sky high this year. You will see it continue. This is purchase originations throughout the year. Again, you can see this is each August, highest August, certainly on this chart, and will continue to be that way. So again, expect a really, really strong year. Purchase rate lock volumes continue to rise. Price appreciation continue to rise. Very, very strong. Inventory down. This is what we're talking about. Supply is being depleted. Here we start looking at really local factors. It's down, but it's really, really down in the less dense areas. And I mean by a lot. So what that means is that is showing our overall inventory numbers as dropping, because in the low density areas, it's dropped off a cliff. If you've been paying attention and watching us, our higher densities have actually been higher year over year for probably 3 or 4 months. Only now is it starting to catch up, so that those high density areas, that 101 corridor with year over year inventory increases, has grown so much that it's eating into the county and regional picture. And probably in the first quarter next year, we'll show lower inventory year over year. Higher inventory year over year. So this is very important. Where do you work? Where do you live? Where are your buyers and sellers? It's not going to be enough to say inventory is low. It might be up in their area. So watch for this. So we'll show you in a second what that trend looks like in different areas. But again, big picture, inventory is way down. That means strong numbers for 2021 overall. Home prices, again, because of those factors, they just continue to go up in all price tiers. So low, medium, high, overall, they're all rising and all look to continue to rise up going forward. When you look at national numbers, national views, you're hearing stories like this, right? Austin's the place to be. HP's moving there, Tesla's, everybody's moving there. And that's reflected in their housing market. Their year-over-year home price appreciation is really high. It's almost 12%, for example. Here we are, San Francisco, San Jose, poor us, only at 12%, at less than 8%. However, mind you, we're growing and we're starting at above $1.3 million median price. Austin's probably in the 400 or 500. All right. So I'll take your 12% growth on 500,000 median price, and I'll see you with my 7% growth on 1.3 median price. Understand how to look at those numbers. It is sexy. It is hip to write about and read about the growth in other areas. We're no slouch. We're still where you want to be in real estate. This is where, as long as you're above 4 or 5% home price appreciation with our starting prices, no better real estate market than the one we have here. So that'll continue to go. And you can see same thing regionally is going up everywhere. So we're not unique in that aspect. Good numbers all over the place. Interest rates, here we go again. Going really well. Purchase applications continuing to rise year over year. And I want to do this, look at this historically. Sorry for my graphic here, but this is 1990. This is the interest rate, the average interest rate in the country, and these are mortgage applications. Again, sometimes you just got to break it down to its simplest numbers. As interest rates dropped from 1990, purchase applications rose. All right. So when we tell you interest rates shall remain flat for the remainder of next year, and you see since we hit the 3%, around 3%, more and more people are applying for a home mortgage. That's all you need to know. As long as interest rates don't rise, more and more people will apply for a mortgage. Now, once they apply, now they've got to go look for limited inventory. Now they've got to like it. Now they've got to write a winning offer. So there's a lot of work to do there, but you don't start if you don't have interest first. And interest has been going up steadily. It will continue to go up steadily as long as those interest rates stay at or around 3%. So watch for that to continue. Make sure you understand that if you have people who have doubts about what the market is doing, these are long-standing trends. We're not going to do anything to buck this trend. Interest rates are not going to go up in the foreseeable future, and so you can expect this correlation to stay. Interest rate, the absolute number drops, number of people applying rises, okay? So, Silicon Valley, let's take a look at it. Remember, showing time continues to be strong. It doesn't matter the number of properties for sale. It matters how many people want them. And that's what's going to create the froth in our market, and it remains really strong. Again, starting in January, these numbers will not seem as cartoonish because January was hot. So the year-over-year numbers won't be as dramatic, but it'll still be positive, and I want you in that frame of mind going forward. Again, I looked at 2020 versus 2019 new listings, not that many fewer than 2019. Changes to contingent, changes to pendings, and closed sales. That's the bottom line. Big numbers, barely dropped after all we went through. So look for that to continue going forward as a positive and driving our markets here. All right. So wanted to share this with you again. Our local markets continue to move in the right direction. So as of December 14th, this Monday, active single family listings had increased by 73% versus the start of the year. Pendings had increased by 104%. So you can see that demand doesn't matter if we put more houses on the market, buyers were there ready to take them. Condo town was slightly different, but pending still grew. Uh, we talked about 4 or 5 months ago when the townhome numbers started to crash. I said, don't worry about it. It's going to be fine. It's going to be a great market. And we were proven right. Again, simply because we track the numbers. We believe in the numbers. We believe in the data. And it showed us positive growth for the rest of the year in both SFR and condo. Obviously, there's a big difference. Obviously, these are hotter, more in demand, and more activity. But condo townhomes, after slipping in March and April, recovered and have been going nicely. Inventory continues to rise. That just means you got a better shot at a listing. And if you're a seller, it just means it might take you another week or two to sell it. But you will sell it at a good number, at a good price, because the market supports it right now. All right. So keep positive, keep everything looking forward. I don't want to talk about this other than it's the last time you'll ever see it, because I did this to compare how we recovered after stay in place. Starting in January, it's just be year-over-year numbers. I'm glad to get rid of this because it's a reminder of stay in place and being told that we couldn't do real estate. So bye-bye. All right, so let's get into the real numbers. Here we go, the heat maps. This is what I'm talking about. This is the bread and butter. Read the national news, read the national directions, but ultimately what's going on in your market, what's going on in your area. So this is what I've been referring to. Active listings. This is for the second Monday in December 2020 compared to the second Monday in December 2019. So in Sunnyvale, doubled the listings. Santa Clara, doubled. Central San Jose, more than doubled. All these areas in the yellow increased inventory year over year. This is not what you're seeing nationally. This is not what Case-Shiller is going to say. This is not what any of the other publications will say, because they don't focus on Sunnyvale, Santa Clara. You're hard pressed to find San Jose information or Santa Clara. It's San Francisco numbers. Now, I'm not saying that's right or wrong. I'm just saying when you're in somebody's home and they're asking you about the market, you can pull out the national numbers, but they're not talking about their neighborhood. This talks about their neighborhood. So inventory dropping, still in Milpitas, still in Berryessa, still in Evergreen, Almaden, Cambrian, Saratoga. Everywhere else, it's up. In some places, it's astronomically high, triple digits higher. Again, if you're just talking about inventory and you say 118% growth in inventory year over year in Santa Clara, oh my God, prices are going to drop. Remember, they all interact. They all relate. It doesn't matter how many homes we list in Santa Clara. What's important is there a buyer for that house? Are there 2 buyers for that house? Are there 3 or 4 or 5 buyers for that house? The answer right now is yes. List, go up 200%. You'll still have a buyer for it. That means interest in that properties will go up. That means bidding wars will continue. That means prices will continue to rise. How do I know that? Because I track the pendings too. And so you see, despite these numbers, which would be alarming if you just paid attention to that in a vacuum, doesn't matter. Sellers up 118% in Santa Clara. It's okay. Buyers are up 44%. Still more buyers than there were last year. This is what I was talking about. Expect a hot start through the year and to taper off. Buyers and sellers in Santa Clara County always start here. So when we see early in the cycle, and I feel like it's at the end of the year, but early in the buying selling cycle, inventory is rising. Buyers are keeping pace, right? But if this continues for the next 2 or 3 months to go up triple digits, eventually we will see this pending number drop. Eventually prices will rise at such a rate that interest and affordability will drop. It won't go negative, but don't expect to be fielding 20, 30 calls a day, 15, 20 offers in Santa Clara in June or July. Kind of like 2018, I'm sorry. Started really hot and tapered off. Never reversed, never fell back, but be prepared for that. The numbers are telling you it's going to happen again. I look at this number, absorption rate, pending sales, December, November of this year compared to December year to date. We can see in some places it is accelerating. Remember, anything above 18% is a seller's market. So all well within a seller's market. That's an important caveat. But in some places, it is dropping. So interest is starting to lower already in certain places. Now you saw this, Almaden, pendings dropping by 13%, inventory dropped by 43%. That's because it was so hot and so crazy for about almost 3 or 4 months. And now we're seeing that's still a good number. 68% absorption rate is still exceedingly high into a seller's market. But when you compare it to where it was a month or two ago, you can see a dramatic slowdown. Pay attention to that. What does that mean? Well, for me, that means if you had a buyer looking in Almaden a month ago and they couldn't compete with the crazy offers, guess what? Now they can go back. Now the demand is not quite as white hot. Now they've got a shot. Will it cost more? Yes. Prices are not going to drop, but they can compete. They might even go with contingent offers. So these are the things that you want to really understand to really effectively help your clients. And these are bordering communities, and you can see the differences. And they teeter back and forth from a 2-month period to a 3-month period. So you've got to pay really close attention to what's going on here in these markets. You see relative to last year, this is another really important chart to show you what can you expect in 2021. So December of 2019, first number compared to this December month to date. You can see that the interest last December in this core market that drives most of the rest of the county, really incredibly high. You can see it's still high this year, but especially here, dropping off dramatically. Central San Jose dropping off dramatically. Willow Glen, Santa Teresa, since 101 corridor, dropping off dramatically. Still great number. If I only put up the December number of this year, I'd be saying great seller's market. It's all perfect. It's all great. Everything is good. But that's not how you spot trends. You spot trends by, what does that mean for next time? So last year we were at 332 in Santa Teresa and it exploded, right? So this year we're only at 74. For me, all that means is that we built in that buzz in October, November, December, unseasonably, which is going to take some demand away from the first half of next year. It'll still be good. It'll still be high, but other markets will be hotter. Look at Blossom Valley, 700% absorption rate. You cannot list fast enough there right now. In 2 or 3 months, the same thing that happened in Almaden might happen in Blossom. So current homeowners see that, put their house on the market, go 100, 150, 200K over asking price, and then it saturates, and then it slows down. So watch for these things. If you're interested in Blossom Valley, you should have known this. I have a friend that markets there all the time. I told him this 2 months ago. Go out and get those listings. Get your buyers in now. Don't go in November, December. And we were right because we tracked the numbers. Unless you're all cash, no contingent, this is not your market right now. You can wait 2 or 3 months. You can pay $50,000, $60,000 more, but interest will be great. Your mortgage payment will barely be higher, and you can go in with contingencies potentially. You can go in with a little more clarity, a little more comfort, a little more safety. So which do you want? Lower price? You got to risk something. Higher price, a little safer, a little easier. It'll be there for you. But watch the trends. All right. South County, you see same thing. Inventory really, really low year over year remaining. Pending still super high. Like those other areas, though, the absorption rates are starting to trick down. They're not as high as they were. They're higher than 2019. I'm sorry, I messed up. What I was trying to show you there was relative to 2019, they're much higher, but relative from November to December, they're starting to trickle down. Still seller's market, but we're starting to show some, finally, after just incredible markets for the last 6 months in South County, maybe it's slowing down a little bit. Perhaps after 6 months of 40, 50% lower inventory, buyers are giving up. There's nothing to buy. There's no choice. It is very hard to get in there. So again, watch these numbers. All these markets are related. They all interact with each other. They all intersect. All right. So we'll finish with this here. I like to use this chart because it's a really good visual. It shows you 2020 inventory in these key markets in Santa Clara County versus 2019 and 2018. Inventory is rising across the board, especially relative to 2019. Almost everywhere, it is higher than it was in 2019. So you see that inventory rising. is starting to get closer to 2018 levels. I expect 2020 inventory will be higher in almost all of these areas versus any of these 3 previous years. So we will have more to sell. More and more homeowners are going to decide to list next year than in these years. Which markets, which neighborhoods, and how will the demand shake out? Those are going to be the key questions. The general direction is clear, but the specific examples, specific neighborhoods, specific price points are going to be different. And why do I feel it's okay? Because I continue to see this. We already hit where pendings have consistently stayed above both 2019 and 2018 for almost the entire year in almost every single region. We showed you earlier how purchase applications remain on a steady upward beat because interest rates remain at historically low rates. So they can't buy if they don't first apply for a mortgage, generally speaking. They apply for the mortgage, then they go out with you and see what's available to sell. Based on the price, location, type of home, they may or may not write. So step 1 is purchase application. Step 2 is locking that rate because they liked what they saw. Step 3 is closing it. So all of these things are positive going forward. Don't be afraid of the rise in inventory as long as demand keeps outpacing that supply. Again, for the foreseeable future, certainly the first 3 or 4 months of 2021, all those indicators are strong. All of those are going to be pointing towards more business, higher prices, a really, really competitive real estate market for buyers and sellers. Over time, things are going to change. If the pandemic, if the vaccines work really, really well, you're going to see us opening up our economies. You're going to see us maybe the demand to work remotely lessen. Maybe that starts to shift away from less dense to more dense. Look, if that happens, for example, homeowners in Morgan Hill and Gilroy that have gained $100,000, $200,000, $300,000 in equity, to take that and buy back into Santa Clara County North. Look for things like that. So we're going to be seeing some really incredible, interesting nuggets by region, by zone. The national numbers are all going to be good. That's not going to get you sold. The regional numbers are all going to be good. That's not what's going to drive your decisions. Take those as a starting point. Look and understand at these micro level indicators to see if you have a home in Saratoga and you want to move to Morgan Hill. Very specific indicators there on what you do and how you do it. If you are in a condo townhome in East San Jose and want to move to Cupertino, very specific indicators on both sides of the transaction on what to do and how to do it. So we're going to continue to share this information with you throughout 2021. So in some ways, this is almost like the kickoff for 2021 because I think we're there. We're already there. The market's there. The numbers are there. The direction is there. So I want to thank all of you for listening. I'm going to see if I can, in the last couple of minutes, okay, here's the condo townhome market. All right, so we are at 1 o'clock. I see Grace wrote a question. So if Grace is still there and anyone that wants to hang in past 1 o'clock, I have information specifically for condo townhome market. So I'll answer that. Everyone else, if it's 2 o'clock and you've got something else to do, thank you for joining us. Really appreciate it. If you want to stay for the answer or even ask another question, hang in there. All right, so Grace, here is your answer. Condo townhomes, let me see where it's at. All right, so condo townhome market, again, I referenced that a little earlier. We had really, really tough months in March, April, May. It seemed like it was going to just implode. For those of you that were listening to me and watching, I said, hang in there. It's a good market. It's going to rebound. That's an initial shock. There's a lot of short-term indicators in terms of wanting space, wanting openness, not wanting to be walled in during shelter in place. That didn't make condo townhomes the first choice for home ownership. But I said that will ease over time and buyers will rush back in, and they did. So here's what we saw. For example, October, November, number of inventory dropped, new listings, so they all dropped. But comparing it to the previous year, look at the rise in all of it. Listings, new listings, sold, and pended. Comparing December, this last 15 days of data or so, you can see compared to a year ago, which was a great market, by the way, for sales doubling, new listings continuing to skyrocket, but the solds and the pendeds are still there. Again, when these numbers are this high, as long as these are positive, that's a good number. It just means it might take you a little longer to sell it. As a homeowner, it might take you, if you're patient, a little longer to get the number you're looking for. If you're trying to gauge the market compared to a single family residence, you're going to be off. You're going to be way off. Your peak, your speed, your amplitude is far different right now for a lot of different factors that we could maybe get into in a specialized meeting in the next quarter. But understand, big trend, general trend, really, really great market. Grace, go get more listings. Those homeowners need your help, and they and you will be well rewarded. The market will be fine. You can see the absorption rate, October, November, looked really good. Late November, December of last year, all the way through February, exploded condo townhomes. The recency bias of what we experienced in March, April, May was compared to this. But if you take out this number, look how steady it's been for the last 15 months. The number of buyers in this market with these price points, they have to look into condo townhomes first. And for a period, they're like, I'm not going into a four walls like that during lockdown. But now we have a little more access and can move around a little more. So they went right back in as they did historically. All right. So if you're comparing it to last November, December, January, February, you're going to be disappointed. But understand, the prices didn't drop. Throughout all this, the prices did not retract. They're still there. You just have to be a little more patient, understanding, and you can see even in this month, the first 15 days of December, better than the first 15 days of November. So trending back up slightly, but expect it to stay right around this range for some time to come. And then big thing, again, if our markets open completely back up by May, June, July with the vaccines, completely back to normal. So distressed a little bit, maybe I shouldn't use that word, that's too negative connotation. Not as robust right now as single families or as it was at this time last year, but still very strong. We're not going to be here, but we're not going to be here either. Expect it to continue around this range, increase inventory, but enough buyers to soak them all up over due time. I'm talking 60, 90 days, not in 10, 12 days. Hope that answered your question. All right, I think it did. All right, so thank you again. I don't see, I'm sorry, a couple of you had their hands raised and I was not able to really figure out how to see that. So if you had a question, I didn't get to it, send me an email at robertcruz@antero.com and I'll try to answer it. Otherwise, everybody have a great holiday season. Have a Merry Christmas. And I think we'll see you first week of January with the next update. And hope you all finish 2020 strong and be ready to run and go hard in 2021. It's going to be a good year. All right. Bye-bye, everybody.